When was the last time you actually read your bank statement? Not glanced at the balance, actually read it, line by line. Most people never do, and the bank is counting on that. Right now, while you're watching this, your bank is quietly pulling money out of your account through fees so small, so buried, so expertly hidden that most people mistake them for normal. They're not normal, they're engineered, and by the end of this video, I'm going to show you exactly which 5 fees are draining your retirement and what the wolf does to make them stop. If you've ever felt like your money works harder for the bank than it does for you, you're right, and you're in the right place. I'm the wolf. I spent years inside the system, watching it, running the numbers nobody wants to run, doing the math that makes financial advisors uncomfortable. What I found wasn't complicated, it was just hidden, and hiding things is what banks do best. Before we go further, if this channel is new to you, hit subscribe. The wolf doesn't repeat himself. Every video is a new weapon. Miss one and you're leaving money on the table now. Let's talk about Mark Davies. Mark is 48 years old, lives in Phoenix, Arizona, makes $72,000 a year, has a checking account, a savings account, and a credit card, all at the same big bank. He chose the premium checking tier because the banker told him it would save him money. Mark believes he barely pays any fees. Mark has paid $23,400 in fees over the last 12 years. He has no idea that $23,400 invested in a simple S&P 500 index fund at historical average returns would be worth just over $41,000 today, sitting in Mark's account, compounding, working. Instead, it's sitting in the bank's earnings report because Mark never read his statement. Let's go through all 5, because at least 3 of them are hitting you right now. Fee number 1, the monthly maintenance fee. The average big bank charges between $12 and $25 per month just to hold your money. That's up to $300 a year for the privilege of letting them use your deposits to make loans at 7%, 8%, 24% interest or while paying you 0.01% on your savings. Read that again. They borrow your money. They lend it out at a massive markup, and they charge you a monthly fee for the service. Mark pays $15 a month, $180 a year. For 12 years, that's $2,160. Gone. Not invested, not compounding, gone. The fix is simple, and I'll give it to you at the end. But first, fee number 2. Fee number 2, the savings account yield trap. This one doesn't show up as a charge on your statement. That's what makes it so dangerous. The national average interest rate on a traditional savings account right now, according to the FDIC, is 0.45%. Meanwhile, inflation is running above 3%, which means every dollar sitting in your savings account is losing purchasing power every single month. Not dramatically, just slowly, like a tire with a small leak. You don't notice until you're stranded. Mark has $14,000 in his savings account. At 0.45%, he earns $63 a year. A high-yield savings account at a credit union or online bank, Ally, Marcus, Fidelity, currently offers between 4.5% and 5.1% APY. That same $14,000 earns $700 a year. The difference is $637 annually. Over 10 years, with compounding, that gap becomes more than $8,000. Mark is leaving $8,000 on the table. Not because he made a bad investment, because he never moved his savings account. Fee number 3. This is the quiet one. This is the one that costs the most. The 401k expense ratio. I talked about this in the last video. I'm going to say it again because it is that important. The average expense ratio in employer-sponsored 401k plans is 1.0% to 1.5% per year, according to the investment company Institute. Vanguard's own research shows that a 1% fee difference over 20 years reduces your final retirement balance by more than 17%. Mark has $89,000 in his 401k. His plan's average expense ratio is 1.2%. He thinks that's normal. It is common. It is not acceptable. At one point, 2% in fees versus 0.04% in a low-cost index fund. Mark loses approximately $68,000 over the next 17 years, not to market crashes, not to bad luck. To a percentage point he never questioned, $68,000. That's not a rounding error. That's a retirement Fee number 4, the credit card interest trap. Mark carries a $4,200 balance on his bank-issued credit card. He pays the minimum every month and about $105. The card charges 24.99% APR. At that rate, paying only the minimum, Mark will spend 5 years paying off that balance. Total interest paid, $2,900 for $4,200 in purchases he already made. He's paying for the past with his future. The average American household carries $6,000 in credit card debt, according to the Federal Reserve. At 24% APR, that's $1,440 a year in pure interest. Money that generates zero return. Money that buys nothing. Money that evaporates. The wolf does not carry credit card balances. The wolf uses credit as a tool, cashback points, on a float, and pays in full every month. The bank makes nothing. The wolf takes the rewards. Fee number 5, the overdraft and transfer fee machine. Banks collected $7.7 billion in overdraft fees in 2023 alone, according to the Consumer Financial Protection Bureau. $7.7 billion from people who were already running low. Mark got hit twice last year. $35 each time, $70 total. Small number. But the CFPB data shows the average overdraft user gets hit 7 times per year. That's $245 annually. From people who can least afford it. There's also the wire transfer fee, $25 to $35 per domestic transfer at most major banks. The foreign transaction fee, 1% to 3% on every international purchase. The paper statement fee. Yes, some banks still charge $2 to $3 a month for mailing you your own financial records. Each fee alone feels manageable. Together, they are a slow drain on the only thing standing between you and retirement. Here's the number that should make you physically uncomfortable. Over a 30-year career, the average American pays between $150,000 and $300,000 in avoidable banking and investment fees. According to NerdWallet's 2023 analysis, that figure, invested instead of paid in fees, would be worth between $400,000 and $700,000 at retirement. That's not a second home. That's the difference between retiring at 62 and dying at your desk at 71. The bank didn't steal it with one dramatic heist. They took it in $15 increments, in 0.01% yields, in 1.2% expense ratios, in $35 overdraft slaps, death by 1,000 paper cuts. And the paper cuts are in the fine print. So here's what the wolf does. 3 moves, starting today. Move 1. The 15-minute statement audit. Pull up the last 3 months of your bank statements right now. Look for every line item that isn't a purchase or a transfer. Monthly maintenance fee, overdraft fee, wire fee, paper statement fee. Write them down, add them up. That number, annualized, is your fee tax, the amount you pay every year for the privilege of being a customer. Most people who do this exercise for the first time feel sick. That's the right reaction. Use it. Move 2. The surgical switch. Monthly maintenance fee. Move to a credit union or an online bank. Ally, Schwab, and Fidelity all offer checking accounts with 0 monthly fees, 0 minimum balances, and ATM fee reimbursements nationwide. Savings account earning 0.45%? Open a high-yield savings account today. Takes 10 minutes. Moves your yield from 0.45% to 4.5% or higher. That single move on a $10,000 balance puts $400 extra back in your pocket every year. 401k expense ratio above 0.5%. Log in. Find the equivalent Vanguard or Fidelity index fund in your plan. Switch. If your plan doesn't offer low-cost index funds, that is information worth bringing to your HR department. In writing. Move 3. Make the bank pay you. The wolf doesn't avoid banks. The wolf uses them strategically. A cashback credit card paid in full every month earns 1.5% to 2% back on every purchase. A rewards checking account at certain credit unions pays interest on your balance. A Fidelity brokerage account used as a checking account currently yields over 4% on uninvested cash. Stop paying for the relationship. Start getting paid for it. Mark Davies can get $41,000 back. Not all at once. Not through a miracle, through 3 account switches and 1 401k fund change. That's it, 4 decisions. Most people never make them because they never ran the numbers. You just did. The sheep keeps paying, quietly, every month, for decades. The wolf reads the statement, drop fee-free in the comments if this video just cost your bank money. Because it did. And if you want the next move, the exact strategy the wolf uses to build the first income-generating asset outside the banking system, subscribe. It's already waiting for you. The sheep stays comfortable. The wolf stays dangerous. See you in the next one.